Welcome back to another weekly Market Insight. Joining me today is Chris. John is actually out. He's in Arizona. I think he may be on the plane coming back, or maybe he's probably hiding somewhere here in St. Louis, but he's out. And Chris, you're joining me today. I'm glad you're here.
Thanks for having me.
Why don't we just jump into it?
Yeah.
So one of the things that we're going to cover is last week's miss. The payroll came in from the Bureau of Labor Statistics at 266,000. But the expected was 1 million.
It kind of raises concerns for both that number, 266,000, and the estimate of 1 million.
And one of the things we looked at is it looks like they're just drawing a ruler for the estimate, right? It just continued to go on, and we missed 266. But that absolutely caught the media and some concern, as you were talking about. It's from a miss standpoint, if we look at it and we're kind of looking at a standard deviation, a normal distribution, or the probability that this miss would be at this size, biggest miss ever, it's more than 3 standard deviations out from the mean. So shouldn't happen, but it did. And obviously a lot of people are trying to explain it. I think the one that got the most attention plays to a specific view, and I think it's an accurate view. I think this is happening, but it was NOA, which is an organization for McDonald's, and they put out that they're having trouble getting employees or bringing employees on and hiring, and they're saying that it's the unemployment benefits that are causing this. Where the statements were they don't blame individuals, right, but they now have to compete with unemployment benefits, especially with the supplemental benefits that are more than these employers are able to pay, given the cost of things. One, McDonald's in that said that they expect the Big Mac to go up in price, as I'm sure all their other menu items would go. But this has certainly brought some people into the conversation on, do unemployment benefits cause people to not work? What is the incentive? My question on this is, well, the unemployment benefits have been here for several months, right, so actually probably a year now. Why is it that they're now just showing up as a problem? Any thoughts on why that may be?
Well, yeah, at some point you're going to, get to that point of incentives and exhaust the pool of people willing to go back to work.
Right.
Instead of sitting back on and accepting their benefits.
And I think that gets to why some people struggle with this being an effect, because there are a lot of people that are like, I don't care that I'm making a couple of bucks less an hour. I want to get back to work. And then others are saying, and this is going through Twitter, and you actually say, no, that's absolutely the reason I'm not doing it. I'm not getting paid as much. So we think the effect is real. The question is why is it showing up? But we can actually go back. Pennsylvania did incredible work about a decade ago on the effects of social benefits and how they affect somebody relative to the income that they could get. And they took an example of a single mother making $25,000 a year, so working part-time, and the added benefits translated into like a dollar amount for economic benefits, child care, additional supplemental food assistance, and what would be needed to get an equivalent income in the market. And they came up, and this is 10 years ago, right, so $70,000 would be the equivalent. They call that the welfare cliff.
And you're just looking at pure dollars. You're not even weighting leisure versus hardship of actually going back to work.
Right, where it's choice is making $70,000 a year, and I am able to do what I want at home, or have to go in there and struggle and do that. For different reasons, people are going to make different choices, but it's not surprising to see. And also, think about that gap. This $70,000 10 years ago, it's a good salary now. It's a really good salary then, and the skill set that is needed to bridge that gap would be pretty difficult to cover. You're probably going to have to start out at a lower wage, so that's what they were talking about. And we do see that effect here. Probably not as pronounced as that study by Pennsylvania, where a minimum wage person, $7.25. If you look at them on unemployment, they're getting an equivalent of $11.23. Right. And we can see that where the median wage, $20, where unemployment benefits are $17. So it affects different parts of the labor market differently.
What's the other argument outside of just unemployment benefits taking up the additional employees?
One is you mentioned maybe there was a pool of people and we've already hit that, but there's a lot of, so that's what we're trying to get to is like what is that? What is an alternative? And one, there's some funniness going on with the data, right? Is if we look at who is going back to work, who is hired, there's a lot more men represented than women. So one thing is, it may not be disincentives or anything. It may be that the burden of children who are still at home from school is falling on women, and they're not able to go back. And that would align with just some of the things that are happening within the country. Another thing that's a problem with this, where if the labor market is really having to compete with the government to get these people to come back, we should see that in the low-wage employment. And we've actually seen a drop for this in the data. So why isn't that McDonald's, who they're offering money to go just go to the interview.
Right.
And then if you look at Walmart, I think they do a sign-on bonus. Now, one thing is that's not a long-term increase. They're just trying to give some incentive to get that hurdle. But we're not seeing the pull that you would expect if they really were competing with the government. You would expect the low-wage employment to be rising as they're trying to offer higher and higher benefits to attract the person coming in. Another thing that's an issue is it's not, that miss is so big and it's not shown up in other data set. So if we go to ADP, not the Bureau of Labor Statistics, and we look at the data, leisure and hospitality, trade and transportation, these are the areas that are picking up the most jobs.
And the most job openings.
And the most job openings. And then if we look at ADP's data for April, 742,000. Well, that's a lot different than 266,000 and much closer to that 1 million estimate. So at the moment, we think that there's a lot of things that are going on here. One, it's probably a major part is sampling. The way that the Bureau of Labor Statistics is trying to control for things such as, are you working part-time, are you contracting, are you going full-time? How many companies have been created, how many companies are lost? How do we factor that in? There may be some sampling error, and that's especially likely whenever we don't see other data that the ADP doing payroll, right, where it's not showing up in their data. So at the moment, until we see other data, we just are going to consider it a sampling error, a problem with the way that they build up.
So you just think we need a little bit more time?
Yes.
About 10 states have said they're going to try to reduce that unemployment benefit so maybe we'll see if that
right.
plays
So
out.
It won't be a counterfactual, right?
Right.
We would have one state doing X, another state doing Y. I think Missouri is going to vote on it here, or maybe it's going to the governor's desk, where they're going to be ending the unemployment benefits that were going to be placed in September. You already have states, Wyoming, South Carolina. So we'll see in those areas on how much of an effect that those unemployment benefits are actually having. Because if they lower that and there's really not much change, then you could say, well, that at that moment, it's certainly going to make it easier for those states to bring on employment. You would expect them to outpace the states that don't have it just because of the way the incentives are, but we'll see if it's drastic or not.
So that's the economy. How does this really affect the stock market?
So what's been driving the stock market is we've advocated, and I think most people agree, is the stimulus. That's whether it's federal stimulus or really ultimately the source of that is the Federal Reserve.
Right.
And the Federal Reserve still sees these unemployment numbers. They have a dual mandate, maintain the purchasing value of the currency and keep unemployment low. And they think inflation's transitory. They've moved to a 36-month rolling 2% average, so they'll overshoot it. When we look at the data, we have some pretty low numbers going back 36 months. So they can run it hot and said that they'll run it hot. They think the inflation isn't a thing. They're also working out of a paradigm, which is basically it's a trade-off between inflation and employment. And why they still go with this, knowing that the 1970s says you can have high inflation and high unemployment, we're not necessarily sure. But whatever it is, the Fed is going to continue to be accommodative.
So the slide here shows current Fed balance sheet.
Yes.
And then current asset purchases, which are $120 billion per month,
Mm-hmm.
$80 billion in treasuries, $40 billion in mortgage-backed securities, and it continues the trend through the rest of the year.
Right.
Do you think that's a realistic expectation?
I think it's a realistic expectation. In addition, if we look back and we see that jump, what was that? That was all the stimulus spending by the U.S. government, which was basically the Federal Reserve monetizing that. So if we have any one of the three bills passed, you're going to see another pop up. So this is already just baked in the cake. As you had mentioned, it's at least
120 billion.
Yes, per month. So then the next question is, well, we have economic data or unemployment data that says maybe the recovery isn't happening as quickly as we like. A lot of factors to consider there. It's pretty complex. But inflation's already moving up.
Today.
Yeah, we saw CPI on an annualized basis at 0.8. That's 9.6%, and it was pretty high last month. A lot of people
year at about 4.2 and 3% for core.
Yes. So and a lot of no longer are people saying that we're going to have a deflationary period. Right? We even have CNBC talking about their concerns from inflation, and they've usually played those down. So we can see that inflation, if they did cause interest rates to move up, and you're trying to wait out any bad economic data, you can see the 30-year could be down 20%, the 10-year down 8 to 9%, and we've seen that year to date, right? We've seen them lose value, so it's really hard to say you should go to bonds considering that economic data, considering the Fed's going to continue to pump, considering inflation's here, and it possibly could move those interest rates up, causing your bonds to lose value, or just lose value over time because inflation's much higher than what you're getting paid. Next slide is what we talked about. We did a segment. We went through each of the quadrant, but we have advocated that we're in that low and rising inflation because we want to understand how to structure portfolios given the environment that we're in.
So historically, emerging markets, REITs, commodities, and gold have performed well. And year to date, we've seen that performance in commodity and REITs.
Yes.
What are you kind of thinking with how this will show in the rising inflation?
So it's good to look at historical data. It's bad to say, well, if it happened then, it's going to happen now, right? History rhymes, it doesn't repeat. And not only do you need to look at the economic data from past to have an idea of what could happen, you need to have a working theory of the fundamentals also. If we take that emerging markets equity and we go back to the time period that we're studying here, emerging markets was mainly a commodity index, or all those countries were heavily invested in commodity procurement. That's no longer the case today. There are more growth in that emerging market index, more technology companies, which have actually struggled year to date as these things. So this one has growth up 11%, value up 11%, really no difference. Well, that's not what we've seen so far year to date. Another thing on gold, because it is a commodity, why hasn't it been moving up? One is cryptocurrencies, absolutely. Bitcoin is probably taking some flow, like the unemployment and the benefits and the effect on incentives. There's probably more to that story than just Bitcoin.
Right.
One of the countries that was locked down the hardest and recently released, and now we have a lot of cases there, is India, where China uses real estate as a long-term storage of value. We use stocks. India uses gold, and they're one of the big consumers of gold, and they were in a lockdown, so a lot of the demand for jewelry and other things in gold wasn't there during the lockdown. So that probably, not only does gold have to compete with Bitcoin, but on the jewelry consumption on the metal, that was gone. It's now back, so we think gold will more resemble commodities in a low and rising inflation over time. It's just had a couple of headwinds, and as Bitcoin and Ethereum and all these others become more expensive, a lot of people will say, I don't want to do $60,000 in a coin. Why don't I look at gold because it looks a little undervalued? So it'll eventually work its way out. Real estate has been doing well, but it has a lot of headwinds as well.
And it struggled a lot last year, so it was really a benefit of kind of the reopening and that value rotation.
Yes. So it's important to look at these different asset classes, and I think the last year really demonstrates that. What are we looking at here?
So here in gray, you have the end of 2019 through November 6th, the last market day before the big announcement of 90% vaccine efficacy the next Monday.
Right.
So that was the big performance and growth up to the year. And then the value rotation afterwards when the vaccines would push towards more of a reopening. So you can see The growth stocks like online retail did well over 60%, while energy was down 50%. But a good thing to point out here is, while there has been a reversion, retail and some of those growth names are still up.
Right.
They're just lagging the value side.
Yeah, I think only groceries, which is slightly negative, is the only green line that's below. Certainly not the returns that you got in energy, but a positive number is a good number. We're starting to see this in our technicals and making changes, which we'll get into it a little bit, but especially on the taxable side, because there are tax implications. Right. But if you've been very growth oriented coming out of last year, you're very happy looking back 1 year. But if you look year to date, that growth side has certainly struggled relative to that value side. So then if we look at the price points on the market, we continue to climb the wall of worry. Since really that miss on employment data, the market didn't sell off that day,
right.
But it seems over the weekend as it digested that, maybe that's the reason. Media is always looking for a reason. Maybe that's the reason. Could be a lot of other factors. But we're not even close to the 50-day yet. It would be healthy to touch that 50-day. And if we were to sell off and go further down, there's still a lot of support there on technicals, but also with just the amount of cash that's sitting in the sidelines now. I think you're going to cringe when I say cash sitting on the sidelines, right? Because cash is, if I buy a stock, we just trade cash. It's always
now I have the cash.
Right. Yeah. It didn't disappear whenever I bought the stock. You have it. But what is meant by that is, in investment accounts, when we look at money market funds in investment accounts, there's high cash balances. So if we do get a sell-off, that's a lot of cash that's probably going to go in and step in there. So any prolonged downturn is unlikely. Not to say we can't have a 10 or 20% correction, but it being prolonged is probably unlikely. People will take advantage of cheaper prices on stocks and start to reallocate that money. Now this is the S&P 500. Doesn't look the same for the Qs, right? No. Which is those growth stocks.
Right. This is the NASDAQ 100 with an overweight to the large cap, mega cap tech.
Right.
And you can see this was a bearish chart for sure. You see a head and shoulders forming potentially. But when we look at it from an intrinsic value, discounted cash flow, forecasting out earnings and discounting them back today, some of these names look pretty attractive.
Right. So we're in earnings season. Amazon, Google, they've all reported, and they reported earnings that were they kind of up?
Yeah.
They were up substantially. And I think you had mentioned that Tao talks about, why do you need small
right.
cap whenever
you get the same growth rate out of the mega cap?
Right.
Why do I need small cap growth?
And what's probably happening on why they're pulling back is just the discount factor later on, that long duration. Just like it happens in bonds, that same effect is in equities. It just doesn't last as long. Right. So it's nice to see some of the price come back. That doesn't take away from the growth story of tech, but it is causing us to make some changes right. in taxable accounts.
So the main thing that we saw week over week was we've seen this kind of large move. Growth value has changed multiple times over the last couple months. Last week we did get a pullback in growth, so that was the main. Large cap growth did fall behind the S&P 500. We are at that long-term date in some of our holdings. Mm-hmm. We were very over-concentrated large cap growth, so we're beginning to make trades going forward that we'll be able to announce in the coming days.
Yes, and we'll probably continue to realize, if we see this trend, which is actually starting, so even though it's been bipolar, right. Where it's value growth, value has been winning out and is starting to show a trend that could be there for a couple of quarters at least. So we're making those changes, and that means realizing taxable gains. Now, when we consider, the concentration, it makes sense to rotate, to try to get ahead of our benchmark, or at least keep up with our benchmark. But the other thing with the political risk is capital gains have a potential of going up. It's okay to start setting that basis in your account higher and realizing capital gains that may be, depending on how the law is written, at a lower tax rate. So with both of those factors, trailing our benchmark, seeing the rotation in trends, and seeing the potential increase in taxes, we have been realizing more gains and getting less of those growth names. Still, we think are long-term holds to things that are a little bit more reopening trade, a little bit more towards benchmark. Any other items to cover?
I don't think so.
All right. Well, if you like this, please click down and give us a thumbs up. And while you're there, make sure you click the arrows and share it with your friends. And if you haven't subscribed, Please subscribe. If you have any questions, please reach out to any of our advisors, or you can go to our website and request us to contact you. I'll have Jess, can you put the number up on the screen? I don't know it by heart. I'm not John, where I say it each week, but I will sign off on that. Thanks for tuning in again.